Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of welcoming Kenny Wolfe from Wolfe Investments. Welcome to the show, Kenny. I appreciate you taking time today.
Yeah, Sakar, I appreciate it. Thanks for having me on.
Thank you. For those of you who don't know, Kenny is a veteran of the industry. He has done multifamily, new development. They have hard money lending business as well within their company. So there's a very well-versed company. He obviously does triple net leases as well. So I appreciate you taking time, Kenny. So give us some background as to, how you got started and, where you're at with your company.
Yeah, sure. So kind of background is graduated from Baylor University here in Texas, and then went north to Dallas, found an entry-level accounting job in the oil and gas field, actually. And then from there, kind of grew quickly in that company. And then because of it's oil and gas, it's either feast or famine. Wife and I decided, hey, we got to do something else. And so we jumped into multifamily investing. So we did two passive investments first, a yield play and a value play, kind of to see which business model, or see both business models. And then our third deal was 76 units that we syndicated, raised $825K. We actually still own that asset today. We've sold others, but that one we still have held on to, just because it's a sweet little deal. At 76 units. And I think so far we've pulled out 400% of investors' money, and we still own it. It's a tax-free deal, right? So that's why people keep wanting to refine it.
Awesome.
So we've done that, and then kind of fast forward, we jumped into other markets as well. So our first out-of-state purchase even out of DFW purchase was in Colorado Springs, Colorado. Then we went to Oklahoma, and then Ohio, then Louisiana. So we've been in 5 different states. We're over 4,200 units that we've done. Right now, we currently have 2,800 units. But we've got some others under contract too. So I imagine by the end of the year, we'll be over 3,000 again.
Wow. Incredible.
In 4 states. So we're in Texas, Oklahoma, Louisiana, and Ohio now.
Awesome. So can you help us get started in terms of, you had a corporate career in oil industry and stuff, and, you kind of came into real estate, right? So what was it like about real estate that attracted to you, and you kind of came into the commercial multifamily side of things?
I've always wanted to be my own boss, even in college. I knew that. So, but you got to get started somewhere. So I started a small company on purpose to learn a lot from. And I did, and it was oil and gas. It was a different field, but I did learn a lot about deal structure, entity creation, all kinds of stuff. Because they're a smaller company, you wear a lot of different hats. To me, that was a great learning experience. And then really it was a matter of, okay, if I finally had the capital, I was CFO and junior partner in a spinoff company at 28 years old, doing oil and gas. And so we were making pretty good money in 08 and 09, when no one else was. And then really it was, we can't do oil and gas anymore. We got to figure something else out. So real estate was a draw, but it's been a draw for a long time. My library is full of real estate books. And I did a lot of reading, and finally, also too, my wife said, "Look, you've got enough books. You got to go do something. Stop reading. Go do something."
Sure. Now, obviously, you have a big presence in Texas, El Paso. Several of the deals that you have. What do you look for in a market, or perhaps a sub-market? Like, what are some of the, not really the metrics commonly talked about, but perhaps you are walking the grounds and you're seeing the deals and things like that. What excites you about some assets when you're acquiring?
So kind of on a higher level, on the states I'll kind of drill down. So on the states we're looking for land-lord friendly states. That's an easy answer, right?
Sure.
And then the cities in those states, are going to be, we want economically diverse cities,
Mm-hmm.
and I always pick on Midland, Odessa, but I would not buy in Midland, Odessa, because really, if you buy real estate, you're really in the oil business,
Sure.
or like in Killeen, you're really in the military business. So if
Sure.
there's a deployment, you've got a lot of folks moving out of your property in Killeen. So
Mm-hmm.
I'm going to get a nasty note from those cities one day, I promise, because I say that all the time. But it's true though. I mean, if you're a real estate investor in there, you're going to have much wilder swings. So
Sure.
diverse economy. We want, we look at the median income as the city as a whole. And then, historically low unemployment. What are the jobs? What kind of jobs are they? Kind of on the city level. And then the sub-market, we get really kind of granular. There's an awesome website called city-data.com.
Sure.
And there's a map on there, which is, a lot of it's too much information on city-data. But the best piece is there's a map on there where it breaks it down pretty, maybe within 2-3 blocks of that asset. And it shows you what the demographics were. So really kind of what I'm looking for is the median income. So if we have a property that we can buy for say $50 a door, and the median income there is $45 a door, I'm pretty excited, because a lot of our deals where we've done, there's been a 1-to-1 ratio of a per door price to the median income. They've been really great deals. We've done phenomenally well on those. Some of our A class, we kind of bend that rule, and we've still done very well. But on the B and C, whenever we've done that 1-to-1 ratio, it's just been a home run.
Sure. But the markets are such hot now, Kenny. Do you typically come across that 1-to-1 ratio still, or do you perhaps flex your muscle and go into different, perhaps the cities, submarkets and things like that to kind of see if that ratio you can achieve?
Right. So, I mean, really it's kind of, it's a lot, like we're buying a lot in Cleveland, Ohio right now, because we can find those great cash flow deals. And, I love El Paso. El Paso is not really on the radar for a lot of folks. It's just way the heck out there in Texas, and it's actually closer to LA than it is to Dallas. It's that far away. It's about an hour and a half. But I mean, there's markets like that have really strong demographics and metrics, and they make a lot of money in El Paso. I think the average median income is $54K a year, which is really great out there. They have pretty cheap housing too, so that's really that's kind of what we're looking for. Those cities that aren't discovered yet or that are up and coming.
Sure. And what about, perhaps like an average rent to perhaps the unit, per door price and things like that? Is there any correlation you look for in there?
Yeah, there is. So, well, it's more of if there's a property, we just looked at a property today in San Antonio, and they want $100K a door, and I'd say it's a B, maybe B minus. The average rent is $1,050. So I'm like, absolutely not. I mean, if it's a 1% ratio, you better have a huge value add component to that property, but it looks pretty much fixed up. So to me, I don't get excited about that 1% ratio on multifamily. It's not going to be a lot of value add gain there because we're in a very low margin business. People don't talk about that enough, I don't think. But
Right. No, it's all about, adding to the bottom line, whether you're, doing improvements or doing some efficiency play, through property management and things like that. So it is definitely a game of pennies and how you can add it to the bottom line. I totally agree with you. And that's where I was going with is that sometimes if the rents are smaller and you're still smaller, meaning, modest within that, let's say 700 to 800 range, and you're still in a very competitive, purchasing or bidding environment, then, it's almost like you have to quickly give up some of those markets and not go after some of those deals. Would you agree to that, Kenny?
Yes. I mean, so yes and no. So yes on the existing multifamily, but that's really kind of why we got into development in Dallas-Fort Worth, because we're building an asset right now. It's 88 units, ground up. It's in the growth path of DFW, so it's not quite in DFW yet, but it's about to be in 5 years. So
sure.
But we're going to be all in on that for about 105 to 110 a unit.
I see.
We just sold a C class here in Dallas-Fort Worth for $92 a door in January.
Oh wow.
So to me, it's like I'd rather have a little bit higher basis in a brand new property in the growth path of Dallas-Fort Worth compared to buying a C class at $90,000 a door and how the heck are you going to make money on that? And I think that, they had a good business plan. They obviously raised money for it. So they must, have a plan on how to make money. But, me being in the game since 2012, 2010, really kind of on my first passive, I've seen, we bought that deal at $34K a door. So it's really hard for me to say, oh my gosh, like, 90 a door, how the heck do you do the math?
Right.
So.
Right. So now speaking of, adding value to your properties and raising the NOI and things like that. So when you're analyzing the deals there, Kenny, what some of the things you look for? Are you looking for perhaps maybe adding 20 to 30% of rent bumps through some, whether it's value add or perhaps efficiencies through property management and things like that? What sort of rent bumps you are looking for?
So since we're in so many different markets, we have to be really cautious. We can't take the Dallas,
Sure.
upgrade package and rent bumps to Oklahoma City. It
Right.
does not translate,
Sure.
they just can't afford it. And so, there in Oklahoma City, our upgrade is faux wood, and that's it. And we're getting about $45 maybe $50 a month. So, which is fine because we're only doing faux wood. I mean, the math makes sense still. Dallas, Fort Worth, we're doing a little bit, higher end finish out than that, interiors, but we're getting 150, increases a month in rent. So you can justify your, expenditure. So it just depends on the market where you're at and how you can drive the revenue side, and then on the bottom line, and you guys know this, but your biggest three expenses are going to be property taxes. It's kind of hard to bring those down sometimes.
Sure.
Especially on an acquisition. And then, it's payroll and insurance. So we kind of focus on those top three things. If we can, that's your biggest kind of the needle to move. And then, if they're not billing back utilities, that's a huge thing as well. So you have to look at all. That's what's great about multifamily. There's so many levers to pull. On driving the NOI.
Right. And as far as management goes, Kenny, are you doing third-party property management or you're managing this in-house?
Yeah, so we started out third-party property management, like a lot of syndicators have to do. And then 2.5 years ago, I got frustrated with that. So I bought into one.
Okay.
I own part of Allied Property Management. They do our Texas and Oklahoma properties. And we're actually about to acquire another property management company in Ohio. So bring them in-house as well. So the goal is by the end of the year to have all of our assets under our management companies.
I see. Now, at what point at how many units you were, Kenny, that you decided that, hey, we want to, take our property management in-house? It makes, a lot more sense. What does that sort of thought process or, financial metrics kind of go into all that evaluation?
So I've got colleagues, they were, they actually are building their own management company in-house. I'm friends with them, so I can say this. I think I was smarter. I actually bought into one that was existing.
Sure.
And I had worked with them in the past on a turnaround project that we got from another deal sponsor. We assumed that asset management role from him. But anyways, we used them to turn around. I was really impressed. It was a smaller company at the time, but when we merged together, we were about 3,400 units over. And so it was a win-win really for him. On his side, he could really kind of increase his employees and bring in the right employees on that ship. And then for me, I was able to kind of put my thumbprint on and build a better mousetrap. And we're still doing that, but it's a way for me to get a better product out of the deal. And then on top of that, now we're seeing even bigger gains, because when we bring this other management company in, we'll have about $750 million of property under management. It's ours and the party to combine. So we could actually have a huge discount on insurance, because we can go package that up and go directly to these insurers and, not have to go through a broker. And then because of the size and how we're not all in just one state or one city, it's really going to bring down our insurance cost across the whole portfolio.
Sure. So this is, as we call it, economies of scale, and this is real numbers adding to your bottom line for sure.
Exactly. It's huge, right? So we can do a lot of those kind of things by doing the management company play.
Sure, sure. Now, Kenny, you are obviously, and many states you have a lot more staff and things like that. What are some of your challenges right now in terms of, what things you are looking forward to, what you're looking to improve in your operations and stuff like that?
Yeah, it's a good question. I mean, it was, as a syndicator, you're starting out with just you and you wear all the hats.
Sure.
Your marketing, your investor relations, your all that. So I'm fortunate enough to have built it out enough now where we've got a great staff here, here at our office in Plano. But, I was just talking about this on another podcast. Kind of the next steps, I think we just added an acquisitions guy
Mm-hmm.
to our team because we were getting a lot of deal flow. I couldn't, it was only one of me. And so he was actually an intern for us 2 summers and turned employee. So he's been great to add to the team. So kind of rounded out the team right now, but kind of on the horizon, I see us doing a lot more development plays here in Dallas, Fort Worth, and some other markets. And, if we get another 1 or 2 of those, we want to get someone in-house that's got, experience with that and can be another person to oversee that where I can keep doing what I need to do. So.
Sure, sure. And speaking of development plays, Kenny, what plays into that decision in terms of, what financial metrics you're looking for, or perhaps any risk around development? How do you kind of block and tackle all those issues?
So first there's certain markets I would never build in, or I shouldn't say never. Never is too strong of a word. Today I would not build in. So like Oklahoma City, no way. You're not going to get the rents for what it costs you to build, because it's about the same to build the property in Oklahoma City that it is in Dallas. The difference is going to be your land cost, obviously.
Sure,
but
sure.
Still, I mean, that the materials and labor are going to be about the same, and you're not going to get the rents, there in Oklahoma
to support
City.
that, right?
Support it. So you've got to be in markets that are a little hotter, which is fine because we're kind of, at least right now, for a lot of the properties here in town, priced out of the market. So cities like Columbus, Ohio, I would build in for sure. It's a hot market as well. DFW, we're already doing that. Those are kind of the 2 markets we've kind of looked at to kind of do some ground up development.
And for a new development, then Kenny, what sort of price per unit and sort of the resultant monthly rent you look for? What starts to make sense?
So I mean, here in Dallas Fort Worth, you want your land cost per unit to be a bit between 8 and at the very high end 12,000 per unit. You want that to be right in there. And then it's going to cost you about, depending on, a little bit depending on the size of the unit, but on average, probably 90 to 100K a door to actually build the asset. So again, that's kind of why, our metric is if I can get to 105 or 110 a door all in for property, then it makes sense, because we're going to get rents at $1,200, $1,300 a month. That makes sense all day long to do that.
Sure, sure. And then once you're built, Kenny, what sort of the exit plan is? Like, is it something to own 3 to 5 years and then exit once, it's all leased up and stabilized for the long term? Or are you maybe, planning to exit within, once you lease up, are you planning to like exit immediately within 1 to 2 years? What sort of exit strategies you have around that?
No, and most developers do that. They build it, they develop it, and then they get out. But our plan for this 88 unit at least is to build the property, lease it up, and then do a cash out refi. Go to a Fannie, Freddie, or some kind of agency loan, then hold it probably 5-7 years. But with the cash out refi, we'll have pulled a lot of our equity out of the deal because we have created so much value.
Sure. Now, you have a lot more things going on, Kenny. How are you networking with investors, or perhaps what was it like to kind of find a lot more passive investors over the years? Like, what are some of the strategies you used, or was it organic growth, or was it something you came along through your experiences?
It was a lot of networking. It was a lot of Starbucks meetings initially, right? So because at that time I didn't have an office, just out of my house and every Starbucks in the country. That's kind of how you have to do it, at least initially. And then, there's tons of networking events. pre-COVID-19, obviously, I would go to, as many as I could.
Sure.
Those networking events, and not just in the same city. I'd go to these network now they're nationwide. So you can meet new folks very quickly if you go to some of those 2-3 day boot camps or whatever you're
Sure.
looking for. Those are great to attend to pick up new passives. Then also too, we've made a really big push on social media. So we put out a video every week on our YouTube channel. We're pretty active on Facebook, LinkedIn. And then also too, we do a lot of extra video on property visits and what we're looking for, kind of day in the life, that kind of thing.
Sure.
So
Got it.
It's kind of a way to kind of keep in touch with new investors that way.
Sure. And you have a dedicated staff to handle all of this, Kenny, in terms of, managing the social media, investor relations, and perhaps, doing all these videos, uploading and things like that. How does that play in terms of your operations?
Right. Yeah. No, we have an awesome marketing lady up here. Christine does a great job. So she actually, that was my first hire. She was my admin in marketing, my digital marketing. She had a digital marketing background. I knew that was a big weakness of mine, but I knew it was something that we had to do to grow. And so she was the first hire here. Now she solely focuses on our marketing. We split those admin and marketing roles, but so she focuses on that, does the posts for us. She finds the fiber person to do the post production video.
Sure.
We just shoot it here in the office. It's pretty easy.
Sure. Got it. And also, Kenny, like a lot of, the bigger companies or companies at your scale tend to have, 2 or 3 main partners and things like that. How is your organization? Are you like strong partners, equal partners with anybody, or are you holding a key role in a lot of sense?
So I'm the here at Wolfe Investments. I'm the I don't really have any partners in Wolfe Investments. Obviously, all of our investors are in there, but we don't have we're not a dynamic duo like I see some of my colleagues do.
Sure.
On there. So kind of how I started it and just kept building it myself. And we do have partnerships with in the management company. Obviously, I own part of that, not the full thing. So we have partners with that.
I see. Wow. I mean, it's incredible, Kenny, that, you built such a large, base with all kinds of different asset classes and things like that. So it's kudos to you and all the dynamism that goes beyond it. It's impressive for sure. I have to definitely admire that.
Thank you very much. Yeah.
No, I appreciate it. And also, Kenny, like, you moved into triple net leases, like the true commercial, as we call it. What was the genesis around it? Like, how did that come about?
Sure. Yeah. So we had been doing multifamily for, I think, almost 7 years at that time. And actually, I was seeing a lot of pricing that I didn't understand on the multifamily side. So I asked one of our mortgage brokers, Paul Peebles at the Old Capital.
Sure.
So what do real estate investors do after multifamily? Right? There's this myth of start with single family, go to multifamily, but I figured I would ask that progression anyways. And so, and he said, well, a lot of folks, what they do is they'll either buy medical office or these triple net, double net commercial, retail spaces.
Sure.
And not because they make more money, but because they're a lot less headache after you buy them. Right? So really that was it. I was conversation with him, and then how we focused on dollar stores. That's all we've bought so far. We're open to other things too, but we focus on publicly traded tenants that guarantee the leases. That way we can trust their financials. And we don't buy strip malls or anything like that. We would if it was all publicly traded companies, but that's pretty and then we like the dollar store format because that's the highest cap rate to interest rate you can get.
So was that something you purchased, Kenny, wherein these were existing deals with dollar store leases on them and you acquired those assets? Was it like that, or perhaps was it more like, hey, I'm purchasing the asset and then you are pursuing some Wall Street tenants to lease them? What was that like?
Right. No. So these were all pretty much layup deals. So they already had tenants in them with long-term leases between 5 and 9 years remaining on the lease. They're in this last fund, and we buy them underneath a fund. So that way investors are spread out over multiple stores. Because it is kind of like buying a single family residence. You should not just buy one, because if you're 100% vacant, you're 100% vacant.
Sure.
So we bought, I think seven in the first fund, and we should be either at 8 or 9 in the second fund.
Sure.
So that way they're spread out, kind of de-risk it on there. But 2 of those were kind of what we call blend and extend. And so we're closing one tomorrow. We bought it at just under a 10 cap. It only had 2 years left on the lease though with Family Dollar. But because of our relationships up there now, we've actually have an extension already pre-negotiated. So after tomorrow I sign the deal, Monday or Tuesday, we can sign that extension, and we should be able to sell that property for a 7.5 or 8 cap.
Wow.
So you create a 2 to 2.5% cap rate difference is pretty massive.
Oh yeah. It's a big deal. It's a big deal for sure. So good. Thank you. So Kenny, on your multifamily side, right, how have you kind of grown your your typical capital presence, or perhaps whether it is marketing and things like that? How have you enhanced some of those ends of your company over the years?
I mean, so we did a lot of research on that, kind of where our investors come from, and so 70% come from in-person meetings. So I'll go speak at live events. We co-host the MFIN conference, which we usually host 3 times a year.
Sure.
This year we squeaked in Houston. There's about 400 people in attendance there. So that was great. I worked with Disrupt Equity out of Houston. We put that on together. So that's been a big boost to do that. We also do a local monthly meetup, although that's gone virtual too. So we still do that via Zoom. That's kind of a way to stay in touch with not only our current investors, but also meet new folks as well.
Sure. Awesome. Thank you, Kenny. It's been a pleasure. Thank you for sharing all your, great advice. And just a couple of last quick questions, Kenny. What is some of the good advice you have received over the years that kind of, stays with you every day and kind of keeps you disciplined as you do your operations?
Yeah, sure. I mean, it's always like whenever we see a new possibility, a new business venture to go after, the first question is, who's going to manage it?
Sure.
Today. So early on, my wife and I actually, at a very young age, right out of college, bought a tanning salon. But the biggest lesson we learned from that was that either go big or go home. Work on your business, not in it. And so that was really kind of that's the first question when we look at any new opportunity is go big or go home. Don't buy small apartment buildings. Buy the bigger ones. Your life will be so much better.
Sure.
So much easier.
Awesome. Great advice. Work on your business, work on the people who can do the work, and work in your business perhaps. So awesome advice. Anything else, Kenny?
I mean, that's really it. And also get started. I mean, I had that kind of analysis paralysis, read way too many books before doing my first deal. But luckily I started at the age of 28 and it's done very well for us.
Great. Thank you for coming on, Kenny. It's been awesome. A veteran, experienced person like you can share so many stories. So it is great to have you. I appreciate you coming on today.
Absolutely. Thank you very much. I appreciate having me.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.